Whole life insurance versus term plus invest. The real math. Your insurance agent is sitting across from you. He has a folder, a chart, a very confident smile, and a product that he says will protect your family, build guaranteed cash value, give you tax-free loans against your own money, and grow into a legacy you can pass to your children. It sounds like the most responsible thing you have ever heard. It costs $400 a month. Your other option is a term life insurance policy that covers the same death benefit for $28 a month. You invest the $372 difference yourself in a low-cost index fund. One of these decisions will cost you somewhere between $300,000 and $700,000 over the next 30 years. The insurance industry calls whole life insurance permanent protection with living benefits. The math calls it something different, and the gap between what your agent tells you and what the numbers actually show is one of the most consistent wealth gaps in all of personal finance. Let's build the full picture, both sides, all the costs, all the real numbers. Let's keep this fair. Sarah is 32 years old. She is in excellent health. She earns $82,000 a year and has 2 young children. She wants permanent life insurance coverage, a $500,000 death benefit that will protect her family for life, build cash value she can borrow against, and pass wealth to her children tax-free. She purchases a whole life insurance policy from a major insurer. Her monthly premium, $400, guaranteed for life. The policy builds cash value at a guaranteed rate, earns potential dividends, and the death benefit never expires as long as she pays the premiums. Mike is also 32 years old. Same health, same salary, same 2 children, same need to protect his family. He purchases a 30-year term life insurance policy with a $500,000 death benefit. His monthly premium, $28. He invests the remaining $372 every single month into VOO, Vanguard's S&P 500 ETF, inside a Roth IRA. When the term expires at age 62, he evaluates whether he still needs coverage based on his actual financial situation at that point. Both are protecting their families. Both are making deliberate decisions. The only difference is the vehicle they chose. One of them is about to watch the other pull dramatically ahead. And it will not be the one the insurance agent recommended. Sarah signs the whole life policy, $400 a month, permanent coverage. The agent walks her through the illustration, a multi-page document showing projected cash value growth, guaranteed values, dividend projections, and the eventual death benefit. It looks impressive. The numbers grow. The chart curves upward. By age 65, the illustration shows a cash value of approximately $280,000 and a death benefit that has grown with dividends to over $600,000. This feels like wealth building. This feels like protection. This feels like exactly what a responsible parent does. Sarah leaves the meeting feeling like she made a serious adult decision. Her parents approve. The agent sends a thank you card. Here is what Sarah does not fully understand on the day she signs. Of the $400 she pays every month in year 1, approximately $330 goes to the insurance company to cover the actual cost of the insurance, administrative fees, agent commissions, and company overhead. Approximately $70 goes into the cash value account, the savings component that the illustration shows growing so impressively. The agent earned a first-year commission of approximately 50 to 100% of the annual premium. On a $4,800 annual premium, that is between $2,400 and $4,800 paid to the agent from Sarah's first year of premiums. This commission comes directly from her money before it builds any cash value. In year 1, Sarah pays $4,800 in premiums, and her cash value grows to approximately $1,200. She paid $4,800. She has $1,200. The other $3,600 covered insurance costs, commissions, and fees. This ratio improves slowly over time. The cash value percentage of each premium increases as years pass. But the surrender value in the early years is so low that if Sarah decided to cancel the policy in year 3, she would receive approximately $4,000 back on approximately $14,400 paid in. She does not know this. The illustration did not emphasize it. And she is committed now. She has children depending on the coverage. The internal rate of return on the cash value component of a typical whole life policy, calculated honestly including all premiums paid, runs between 1 and 2% annually in the early decades. The guaranteed growth rate on the cash value is typically between 2 and 3%. The dividend participation, which the illustration projects optimistically, has historically added another 1 to 2% in total return for policies held at major mutual insurers. A realistic total return on the cash value of a whole life policy for someone who holds it for 30 years, approximately 3 to 4% annually. The S&P 500 has returned approximately 10% annually over the same period. That gap, 3 to 4% versus 10%, compounded over 30 years, is where the story gets uncomfortable. Mike buys the term policy and invests the difference. $28 a month buys him a 30-year term policy with a $500,000 death benefit. His family is fully protected. If he dies tomorrow, his children receive $500,000. That is the same death benefit Sarah has. The coverage is identical in the scenario where coverage matters most. The remaining $372 goes into VOO inside his Roth IRA on the first of every month. No fees beyond the 0.03% expense ratio, no agent commission, no surrender period, no surrender charges. The money is his from the moment it hits the account. His coworkers think he is underinsured. His parents wonder why he did not get permanent coverage. His insurance agent, who he consulted before making the decision, suggested he reconsider. Mike does not reconsider. He sets up the automatic transfer and moves on. Month 1, Mike invests $372. It buys approximately 1.79 shares of VOO at $208. Month 2, the same. Month 3, the same. There is no cash value illustration. There is no agent calling to update him on his policy performance. There is no chart showing projected dividends. There is just a brokerage account with an expense ratio of 0.03% and 30 years of compounding ahead of it. That is enough. Let's run the first 10 years. By 2034, Sarah has paid $48,000 in total premiums over 10 years. Her cash value, according to a realistic projection based on actual whole life performance rather than the optimistic illustration, is approximately $52,000. This includes the guaranteed cash value plus a reasonable dividend estimate based on historical mutual insurer performance. She has built $52,000 in cash value on $48,000 in premiums over 10 years, a nominal gain of $4,000, an annualized return, when accounting for the timing of all premiums paid, of approximately 2.1%. Her death benefit is $500,000 plus accumulated dividends, approximately $520,000 total. Mike has invested $372 per month for 10 years into VOO. At 10% annual return, his portfolio is worth approximately $75,600. His term policy is still active. His death benefit is still $500,000. His family is fully protected. Mike's investment portfolio, $75,600. Sarah's cash value, $52,000. Mike is ahead by $23,600 after 10 years. But both policies still have their death benefits intact. The insurance purpose of both is being served. The difference is what happens to that $23,600 gap over time. Year 20. Sarah has paid $96,000 in total premiums. Her cash value, at a realistic 3.5% average annual growth, including dividends, is approximately $138,000. Her death benefit has grown to approximately $560,000 with dividend additions. She can borrow against her cash value. She can take a policy loan of up to 90% of cash value, approximately $124,000, at an interest rate typically between 5 and 8%. The loan does not require repayment, but unpaid loans reduce the death benefit dollar for dollar and accrue interest that can erode the policy value significantly if not managed carefully. Her financial advisor calls this a living benefit. The fine print calls it a loan against your own money at 6% interest. Mike has invested $372 per month for 20 years into VOO. At 10% annual return, His portfolio is worth approximately $280,000. His term policy still has 10 years remaining. His death benefit is still $500,000. His family is still fully protected. Mike's portfolio, $280,000. Sarah's gross value, $138,000. The gap has grown to $142,000 in Mike's favor, and Mike's $280,000 is fully accessible. No loan, no interest charge, no reduction in death benefit, no surrender period. He can sell VOO on any day and have cash in his account within 2 business days. Year 30, the real finish line. Sarah has paid $144,000 in total premiums over 30 years. Her cash value at age 62, at 3.5% average annual growth, is approximately $280,000. Her death benefit has grown to approximately $620,000 with 3 decades of dividend additions. Her whole life policy is intact. Her family is protected. She has a guaranteed death benefit that will pay regardless of when she dies. She also has $280,000 she can access through a policy loan, her own money, borrowed back from herself at interest. Or she can surrender the policy and receive approximately $265,000 after surrender charges, losing all future death benefit permanently. This is the endgame the insurance agent illustrated on the chart. It looks reasonable on paper. It represents 30 years of premiums and guaranteed growth. It will pass to her children tax-free as a death benefit when she eventually dies. Mike's portfolio at year 30, $372 per month for 30 years at 10% annual return, approximately $821,000. Inside a Roth IRA, completely tax-free on withdrawal, no death benefit reduction, no surrender charges, no loan required to access it. His term policy expired at age 62. He no longer has life insurance coverage, but his portfolio is so large at this point that he is effectively self-insured. If Mike dies tomorrow, his $821,000 portfolio passes to his beneficiaries through the Roth IRA, tax-free, just like Sarah's death benefit, and nearly $200,000 larger. If Mike does not die, which statistically is the far more likely outcome, he has $821,000 in accessible, liquid, tax-free wealth to fund his retirement. Sarah has $280,000 in cash value and a death benefit that pays only when she dies. The gap at year 30, $541,000 in accessible wealth in Mike's favor, $541,000 from the same starting point, same income, same need to protect a family. The only difference was $372 a month and a decision made across a desk from an agent with a very confident smile. Now let's be genuinely honest about when whole life wins, because there are real scenarios where it does. And any analysis that pretends otherwise is selling you something just as much as the agent across the desk. Whole life insurance is a legitimate tool for high net worth individuals with taxable estate planning needs. If your estate will exceed the federal estate tax exemption, currently approximately $13 million per individual, a properly structured whole life policy inside an irrevocable life insurance trust can pass a significant death benefit to heirs completely outside of the taxable estate. For this narrow use case, whole life is not just competitive, it is the purpose-built tool. Whole life is also appropriate for people who are genuinely uninsurable or who have conditions that make future insurability uncertain. If you are diagnosed with a serious health condition at 40, your ability to purchase any new life insurance, term or otherwise, may be permanently compromised. A whole life policy purchased while healthy at 32 guarantees permanent coverage regardless of future health changes. For someone with a family history of early illness, the permanent nature of the coverage has real actuarial value. The tax-deferred cash value growth has limited legitimate appeal for very high earners who have already maxed every other tax-advantaged account available: 401k, Roth IRA, HSA, 529. For someone earning $400,000 a year who has exhausted all standard tax shelters, the tax-deferred growth inside a whole life policy represents an additional bucket of tax-advantaged savings that is otherwise unavailable. This is a narrow use case. It is not the scenario being sold to the 35-year-old with 2 children and an $82,000 salary. The disciplined savings argument is real for some people. Whole life premiums are mandatory. Miss them, and the policy lapses. For someone who genuinely cannot trust themselves to invest the difference consistently, the forced nature of the whole life premium creates a savings discipline that the term plus invest approach requires but does not enforce. If Mike would have spent that $372 a month on dining out and weekend trips instead of investing it, Sarah's $280,000 cash value beats Mike's $0 in a brokerage account by $280,000. This is not a hypothetical. Behavioral finance research consistently shows that most people who say they will invest the difference do not invest the difference. If that is you, honestly, not theoretically, the term plus invest math breaks down completely. Here is the framework for making this decision honestly. First question: will you actually invest the difference? Not theoretically, not with the best version of yourself. Actually, consistently, for 30 years, through market crashes and life changes and the various temptations of undeployed cash. If the honest answer is no, the term plus invest strategy does not work for you. Buy the coverage that works for your real behavior, not your ideal behavior. Second question: do you have a taxable estate planning need above the federal exemption threshold? If your net worth is below $5 million, the estate planning argument for whole life does not apply to your situation. If it is above $10 million and growing, talk to an estate attorney about irrevocable life insurance trusts before buying anything. Third question: are you buying this for the death benefit or for the cash value? These are different products that happen to be packaged together. If you need permanent death benefit coverage, there are more efficient ways to get it. Guaranteed Universal Life, for example, provides permanent coverage at a fraction of whole life premiums with no cash value component. If you need investment growth, a low-cost index fund is provably more efficient than the cash value of a whole life policy by every historical measure. The combination product serves neither purpose as efficiently as the two separate products do independently. Fourth question: can you get honest projections? Ask your agent for the internal rate of return on the cash value, not the death benefit, the cash value, at years 10, 20, and 30, based on guaranteed values only, not projected dividends. The guaranteed return on most whole life policies is between 1 and 2.5%. If that number, in isolation, represents a competitive return for your money compared to alternatives available to you, proceed. If it does not, you have your answer. Fifth question: do you understand the surrender charges? Most whole life policies have significant surrender charges in the first 10 to 15 years. If you cancel the policy in year 5, you will receive substantially less than the premiums you paid. This is not hidden. It is in the policy documents. But most buyers do not read the policy documents before signing. Know your surrender schedule before you commit to $400 a month for life. Back to Sarah and Mike at age 62. Sarah has permanent life insurance. She has $280,000 in cash value that she can access through a loan, her own money, at interest. She has a $620,000 death benefit that will protect whoever she designates as a beneficiary. She paid $144,000 in premiums over 30 years. She made a decision that gave her security, permanence, and peace of mind. For her, those things had value. They just had a price that most people never calculate in advance. Mike has $821,000 in a Roth IRA. He has no life insurance, but he does not need it. His portfolio makes him self-insured in a way that no 32-year-old buying a policy could have imagined. He paid $10,080 in term premiums over 30 years, $28 a month for 30 years, and $133,920 into his investment account. His family was protected the entire time. His wealth compounded the entire time. $541,000 separated them at the finish line. Neither of them made a reckless decision. One of them made an expensive one. The next time an insurance agent sits across from you with a chart and a confident smile, ask them one question: what is the internal rate of return on the cash value at year 20, using only the guaranteed values? Because the version of this presentation that uses guaranteed numbers instead of projected dividends is the only version that tells you what you are actually buying. And if you are wondering what happens when you compare a 15-year term policy to a 30-year term policy, when the shorter commitment changes the monthly cost and the investment window shifts, that is a completely different conversation. And the math might change everything you think you know.